All right. I think we're good to go. So I'll get into who I am. If it's all right with you, I'd like to just jump right in. And I do apologize. I've got about 80 slides, but they move fast. And how many of you have heard this before? Just curious. Because I know there's some familiar faces in the room. Yep. And here's the thing. This is one of those presentations where I don't know that you can hear it enough. Because every time you pick up on things that you just didn't know, or you heard it differently the last time, or something like that. So I do apologize, but I really don't. I was sitting at home trying to figure out how to make this 30 minutes, and I couldn't. Because here's the thing. We've been intentionally, I'll call it, conditioned to believe certain things about retirement accounts. And I think in order for you to understand why you having control over your own IRA, 401k, 403b, TSP, government 457 plan matters, you kind of have to build up to it. You have to kind of first sit in, here's why you have what you have. It's not a bad thing, it is what it is. And so I struggled getting rid of stuff. And so Adam already kind of explained why you're here. Like either you're here to be a real estate investor or you're here to probably generate wealth. Oh, I went too far. Generate wealth through real estate. Am I correct? So you guys have maybe W-2 jobs, or maybe you're entrepreneurs, or maybe you're already in real estate, but the objective is to do more. As you're watching this, if you're already investing in real estate, look at it from the perspective of when you go home, think about your neighbors next to you. How many of them are going through their normal 40-hour-a-week job, doing their normal routine, thinking that they have enough, thinking that once they retire, they'll be able to successfully stay retired? Because the truth is, they won't. And so even if you have all of your things in place, you've got your self-directed retirement account, you're invested in real estate, what about your neighbor? And look at it from the perspective of how can I assist them in being able to get there too? Because ultimately the objective is to build wealth through real estate. And I'm pushing buttons in the wrong direction there, it looks like. And how many in here just have a retirement account? I saw the self-directed IRA, but how many have just any type of retirement account? Any type. So keep this in mind, because the question is, how much access do you have with your current retirement account? Meaning, are you capable of investing into anything other than what the mutual fund stocks and bonds you are already offered? And what I mean is, are you able to invest in non-traditional investments? And we'll get into what non-traditional investments are. But just look at it from the perspective of everything outside of mutual fund stocks and bonds are non-traditional investments. And I do mean anything. We're here to talk about real estate, but it could be businesses, it could be liens, it could be land, it could be crypto. It could be anything you want. So the objective is, do you have control? How do you gain control over your own retirement dollars? And again, if you're a real estate investor already, whose money are you using? Are you using yours mainly, or are you engaging others around you? Because I think there's an opportunity to grow this space. Like if nothing else, you guys should be working together at minimum to be able to, right, generate and build wealth. But in addition to that, as I mentioned, as you go home, when you go home and you are driving or pulling into your driveway, how many opportunities are there in your neighborhood to be able to bring them into a space like this? All right. My goal is just simply to rescue and or help you access your retirement dollars, penalty-free and tax-free. And when I say self-directed, what do I mean? Because there's a lot of companies, you can get a self-directed retirement account from Fidelity. But what do I mean? I mean to be able to invest in what you want, when you want, assist your investors in being able to invest in what they want, and also educate others around you. And the last piece, and I think when I was here a year ago, this number was 36 trillion. It's 40 trillion now because the market's doing pretty well. But if I could show you how to access $40 trillion, would that be okay? It's only 40 trillion. It's not much. I've moved down this path of self-directed retirement accounts from strictly being a real estate investor, just like you. I thought I needed 10 doors. Give me 10 doors, give me some tennis toilets and trash, and away we go. But what I realized was I'm a numbers guy. I'm an engineer. I like the math. And when I started peeling back the layers and understanding where the math was coming from, A guy asked me, hey, have you ever thought about where my investors are getting their funds from to be able to invest with me? And stated they use their retirement accounts. My response was, you can't. My retirement accounts are tied up in mutual funds, stocks, and bonds. You cannot use retirement dollars to invest in real estate, because if you do, you will be taxed and penalized. Little did I know, I was wrong. And it started with the Google search. All I did was type self-directed 401k into my favorite search engine. And if you were to do that, what you would find is on the first page of Google is this little company called Self-Directed Retirement Plans. It's the company that I own. It's been there for about 20 years. I bought it from this gentleman. His name's Rick Pendekoski. He owned this company about 25 years ago, and he brought me on as simply just a guy who wanted to learn the business. And as I was learning the business, I realized there's a message to be sent out here. And so my objective is just to extend that. And again, we're on the first page of Google. We're there organically. We don't pay for ads or anything like that. We're kind of word of mouth. It's just, as of today, it's me, Rick, and my wife back there. That's all it is, a part of this company. That's it. And how are we able to assist people? How are we able to do it? It's by creating properly structured retirement accounts and merging them with tax efficient strategies. Just because you have a 401k doesn't mean you can invest in what you want. It has to be designed a certain way. And that's what I do. I'm what's called a third party administrator. I create structure. I give you the structure to your retirement account to allow you to be able to invest in what you want. Whether that's a 401k or an IRA, doesn't matter. You can structure them both to be able to invest in non-traditional investments. A few questions for you guys. And I met a few of you today, so if I don't get participation, I will call you out, just so we're clear. All right. If you had to do them, like from a numbers perspective, how many people do you think retire with $1 million or more in retirement? Just a percentage of Americans, what would you say? Give me a guess. 5%? 1%? 2%? I want to say, as of today, it's right around 3%. What would you think, though? So if about 3% retire with $1 million or more, what would you think is the median retirement nest egg size? Just a guess. 100 grand? But hold on, let's pause for a minute. The median nest egg size being $100,000. Is anyone retiring off $100,000? Like, that's impossible, right? Well, so give me some other numbers. 100,000, what else? What do you think? 250? As of today, and that's because 401ks are actually doing pretty good right now. The median retirement nest egg size is right around, it's like 298. It's right around $300,000. But again, we're talking retirement. If you had $300,000 right now, could you retire? Could you no longer work off $300,000? And again, I go back to this room is tight fit. There should be a lot more people in here, and here's why. Majority of your neighbors are going to end up retiring with $300,000. Is that enough to stay retired? It's not. If you had $1 million, though, what would you guys expect that income to be? If you had $1 million, if I'm a millionaire, if you're a millionaire, what would you expect your annual income to be? What would you expect? What would you hope? No, you wouldn't. Be honest. Okay, I like 80, 100,000. If I'm a millionaire, again, I'm a millionaire. It's on my business card. I'm a millionaire. If I'm a millionaire, I expect 6 figures. I think 80 is probably a little bit more probably realistic after taxes. Yep, I agree. But here's the truth. $1 million in retirement is based off this little thing called the 4% rule. Anyone know about the 4% rule? If you were to type into your favorite search engine, the Trinity study. The Trinity study is the study that was done, I want to say mid-1990s, if I'm not mistaken. And it's because once companies transitioned away from pensions and moved towards the 401k, they did this study to determine how much you need to have in your 401k and how much income you can take from your 401k to make sure you never run out of money, so you don't have to go back to work. And so the 4% rule came out of that. And what that's saying is, if you have $1 million in your retirement account, the max you can take in income is 4% of that number. 4% of $1 million is 40 grand a year. I'm a millionaire, but I bring home $40,000 a year. Make it make sense. But as we talked, the median income A retirement size is 300,000. 4% of 300,000 is 12 grand. Who's retiring off 12 grand a year? No one. But that's the dilemma that we're in. That's the problem that we're having. And the question here, how can you beat the 4% rule? And this is exactly what Adam was referencing. It's simply math. Because the average return, or the average annual return, because you had asked this question, the average annual return for an IRA or 401k, and Google it, it's right there, it's 5 to 8%. So if my retirement account on average is making 8%, let's call it 10, which most are not, but if my retirement account is making 10%, the reason the 4% rule is what it is because if I'm withdrawing 4%, I need to at least make enough to pay for what I've taken and add. So the reason the 4% rule exists is so that you don't run out of money. It's designed to protect you. So how do you beat the 4% rule? Well, it's just math. I have to double my rate of return. I have to make more money. I have to put my money in a position so that it's not being lost. So, okay, where are retirement dollars today? Who are they tied up with? What type of funds are they invested in? You guys know? Normal retirement dollars, what are they invested in? Mutual funds, stocks, and bonds, right? So if I need to beat the 8 to 5 or 8 to 10%, 5 to 10% that I'm making, I need to move the funds out of mutual funds, stocks, and bonds and put them in a better position to be able to make more funds. Now, I like my stocks. I like Amazon stocks specifically, but I like my stocks. So I'm not saying don't invest in mutual funds, stocks, and bonds. This should be an and discussion. Is your money in a position to not just generate wealth inside of traditional boxes, but are you able to access your dollars to invest outside of that? So this should be, my point is this should be an and discussion, not an or. This isn't you should only do this and not do that. But the math states if you stay where you are, this is where you will live, and this is where you will live. So what can we do? How can we do this differently? Oh, and just so we're clear, this is a very random slide, but we talk a lot about rates of return. And as I mentioned, making 8 to 5 or 5 to 8% inside of your retirement account is the norm, is the standard. Here's the piece that most people miss when they talk about the stock market. Everyone talks about, hey, if there's a bump in the market, if there's a downfall in the market, don't worry, buy more because it will recover. They talk about recovery, right? They talk about, hey, you're young, you've got time to recover, don't worry about blips in the market. But they never talk about what that time actually means. In 2022, this is what it looked like. In 2022, the S&P 500 lost 20%. It would take approximately 40 months to recover from a 20% drop in the market in your retirement account. No one talks about that. So think about it. I'm 51 years old. My objective is to retire at 59. I take a hit in the market due to we changed presidents or Elon Musk said something stupid or whatever the issue was in the market. I'm 51, my objective is to retire at 59. I take a 20% hit in my retirement account. It's going to take me almost 4 years to recover. So what does that do to my retirement date? But no one has that conversation. What they say is, hey, the market's on sale. It's cheap. Keep buying, right? And so my point is, as long as we stay in the market, we are limited to what the market can or can't do. And again, this is not an or discussion. This is what can I do in addition to what's happening in the market? And there's five ways we kind of educate around how to, I'll call it, counter what the market is doing. I'm only going to talk about self-directed retirement accounts. But just so we're clear, I think if you were to go to my YouTube channel, it talks about self-directed strategies, but I think it actually should be named how to access your leverage because it's about leverage. Meaning, I've got this IRA, a 401k, a 403b. Are you able to leverage it today? What you will get out of this conversation that will probably take me about 35 minutes is here's how you can access and or leverage your retirement dollars. But there are other places. Do you have a home? Is there equity in that home? Do you understand how to leverage the equity in your home? Or were you conditioned to believe you need a mortgage and the only way to access the leverage in your home is to get a second position home equity line of credit, you got 2 payments, or you have to sell the home? There's actually a better way, an easier way for you to be able to access the leverage that you have. Cash value life insurance products, that's that SKIA part. Secure compound interest account is what it stands for. A lot of people think life insurance is just based off death, but life insurance is actually meant to assist you while you're here if you structure it right. And so my point is, there are other areas where there's leverage located so that you can beat or exceed or surpass that 4% rule. Because the 4% rule has been placed on you, but don't allow that 4% rule to limit you to be able to do what you want. Am I making sense? And I meant to say this earlier, also move fast. So my apologies. We're going to talk about a few strategies. I think I'm going to hit everything today with the exception of Rob's. So we'll talk about IRAs, 401ks, Roth versus traditional, and leverage. Because a lot of people don't realize your retirement account can actually borrow. It can go to a bank and ask for a loan to be able to bridge opportunity. So we'll talk about that. And everything that I'm going to walk you through today, when I say self-directed, I mean control. So I mean checkbook control, no waiting to make a decision. And the biggest piece for me is the bank isn't in your way. Those of you who have a self-directed retirement account, are you able to simply write a check from your checking account, or do you have to do things through your custodian? Because to keep, and let me be very specific, if you've got like an equity trust or an IRA services or a company like that, 9 times out of 10, you might have control over your retirement dollars, but the actions you take have to go through the custodian. I'll walk you through why. I'll walk you through an opportunity to get beyond that as well, I guess. This is you. The objective here is to become a millionaire. And how do you do it? You do it through real estate. And so my objective is to provide you some tax efficient strategies for you to be able to do so, which is also why you're here, right? And I think, Adam, you did an amazing job of kind of connecting some of the dots, because I don't think I have to. It's the opportunity is to beat the 4% rule. How do you beat the 4% rule? Well, I need double-digit returns. I think what you shared was, here's how you can get some double-digit returns. Otherwise, you're stuck with the 4% rule. Any financial advisors in the room? I don't mean to poo-poo on financial advisors. I actually have great relationships with most of them because I come from a perspective of this is an and conversation. I'm not telling you to buy this over here and don't do that. I'm not saying that. That's not what I do. I think there's a partnership opportunity that I should have with your financial advisor. Why? Well, the reason your financial advisor can't tell you to go work with Adam and invest your retirement dollars in real estate, it's because they can only offer you what they have to sell. Meaning, in most cases, your financial advisor works for Fidelity. Name the property that Fidelity owns that you can go invest in. It doesn't exist. What can you buy from Fidelity? Mutual funds, stocks, bonds. What can you buy from Morgan Stanley? Mutual funds, stocks, but what can you buy from Edward Jones? Right? So they can only offer you what they have to sell, and legally they are bound to only offer you what they sell. So therefore, someone like me, I can help you become structured so that you can invest in other things in addition to, not instead of, but in addition to. Why? The goal is to beat the 4% rule. The goal is to create double-digit returns. How do you create double-digit returns if you don't have control to be able to step out of mutual funds, stocks, and bonds? Am I making sense? Any questions about any of that? A few questions you can ask your financial advisor is, can I have multiple 401ks? I got one. I have a 403B with the company that I work for. Can I have an additional one? You absolutely can. You're not limited to the number of 401ks you want. Can you have multiple IRAs? You absolutely can. Can you invest, or how do you invest in real estate with the dollars that are sitting with, I don't care the name of the firm, but whatever the custodian might be, how do you invest in real estate? And anyone know what Rothschild is? You guys weren't listening the last time you were here. I'm just kidding. Rothschild is a completely made up word. But I think it really does fit. And I'll use me as an example. I'm 51, I'll be 52 next year. Let's say I've got $200,000 in traditional dollars. Traditional just means I haven't paid taxes on it. What if I wanted to convert those dollars over to Roth? Rothicize is saying, well, if I'm 51, I got 9 more years before I can even access these dollars. So instead of me taking the tax hit on $200,000, why not divide 200,000 by 9 and convert that dollar amount every year? By the time I'm 59, it's all converted and I'm now tax free. So Rothicize is just saying, hey, is there a way for me to take action to be able to live in an environment where I'm paying as little taxes as possible and to avoid UBIT? We will not dig into UBIT today, but if you're not aware of UBIT and you're in the real estate space, you need to be aware of UBIT. And I'll leave it at that. We can talk further about it later. And then also, let's say you have assets in your personal name that you want to move into your retirement account. Why? Because there's an opportunity to build tax-free wealth inside of your retirement account that you can't do personally. Well, there's a way to do that as well. It's a little bit unique, but there absolutely is a way. And as I mentioned, we will absolutely talk about how your retirement dollars are allowed to borrow from a bank. But let's start with the basics. When you hear me say self-directed, what do I mean? I simply mean control. You're able to invest in what you want, when you want, without someone standing over your shoulder going, don't do that. You have full control over your retirement dollars, and that can be a little bit heavy. Because it may sound great, but when you have a checking account with 1 point whatever million dollars in it, and you have checkbook control over those dollars, it could get pretty heavy. But the bottom line is you have control. And when I say you can invest in non-traditional investments, what do I mean? This is not an exhaustive list. This is actually a pretty short list. It is unlimited, the actions that you can take. It would be much easier for me to tell you what you cannot invest in versus walk through everything you can. The key piece is you have control to be able to take action. So let's talk about IRAs. This is my favorite slide throughout this deck. And it's simply because of this. In 1974, the contribution limits for an IRA is $1,500. Anyone know what the contribution limit is today? $7,000. What's the difference between 1974 and 2024? 50 years. What were eggs in 1974 and what are eggs today? Right? 10x, 20x. But why isn't the most important, like if you were to ask any congressman, what's the most important retirement vehicle you can have? You know what they'll say? The Roth IRA. If the Roth IRA is the most important retirement vehicle, why is the contribution limit not 10x, 20x, so that you can actually achieve a goal? Who benefits from the Roth IRA being the number one retirement vehicle, but the contribution limits being $7,000 to $8,000 a year? Who benefits from this? Just think through that. Government. How about just not you? Right? There's a whole lot of people that benefit from you depending upon this retirement vehicle, and none of them are you. But this is an individual retirement account, an IRA, individual, it's mine, it's for me. But I'm not the one that's able to successfully accomplish my goals using it. Make sense? So IRA contributions again, $7,000 and $8,000 this year. They are not going up. They are not improving this year. That's where they're sitting currently. And, let me go back. To contribute to an IRA, it does take any earned income. So anyone can have one. And just so I'm clear, some of us in this room have to have an IRA. Some of us are limited to only having an IRA, and that's okay. But just understand the vehicle that you have. We need to be aggressive in our investment strategy if you're going to turn $8,000 a year into a tangible income that you can actually live off, right? You've got to put that $8,000 to work, which means we need to get it out of the mutual fund, stocks, and bonds and into a bit more of a secure vehicle that can produce double-digit income. It's the compound interest part. We need to put your dollars in a vehicle that can produce that compound interest successfully, right? And this is all of us, right? Right? Bring it on. So my point here is usually the call I get is, hey, I want a Roth IRA. And I ask, what do you have or why? And what I learned is most people don't understand the difference between traditional and Roth dollars. So just keep it really simple. It's about when your dollars are taxed. When I'm talking about traditional, I'm talking those dollars have not been taxed yet. When I'm talking Roth, I'm talking, hey, we're paying taxes today because we know the tax rate today, but the growth on that is growing tax-free. We should all be living in a Roth environment. And I know that sounds strange. No one wants to pay taxes. But here's the piece. You know the tax rate today. You may not like it, but you know it today. Your job, who offered you that traditional 401k that they're matching at 5, 7, 12, 15%, whatever it is, we've been conditioned to believe that that's a win. Hey, I am not paying taxes today. Lucky me. But what that means is you're opening yourself up to be charged whatever the tax rate is in the future. Again, common sense, 74 to 54, 74 to 24, 50 years. Is the tax rate higher or lower today than it was in 1974? Obviously. So will the tax rate today in 2024 be higher in 44 versus today? Absolutely. So why the hell would I want anybody's traditional retirement account? We should all be focused on trying to live in a Roth environment. Some of you work for companies that won't allow you. Okay, now you know that. You just need to be able to put your money in a position to where it can. I'm not saying don't contribute to your company's retirement account. Take the match, take the money that they're giving you. Awesome. I don't know that I'd go beyond that unless they can offer you a Roth factor. Pay your taxes today so that you can build unlimited wealth. Because the cool part about Roth is you pay taxes on the seed and you get the harvest for free. And that's not, you get the harvest for free today, you get the harvest for free unlimited. You pay taxes on $5 today, it can grow tax-free from now until you pass, which is pretty powerful. Now, there are rules associated with becoming Roth, and again, I'll just slide through these real quick. Most people think Roth is some special account. You have to create a Roth IRA. And in truth, Roth is just a decision. Roth is you deciding, I want to pay taxes on the dollar amount that I'm investing so that I can build tax-free profit. And I'll give you an example. Let's say it's January 1, 2025, and your objective is to invest in a space like this. And you're investing your traditional dollars of $50,000 in whatever the fund might be. Fund number 2, I think it was 1, 2. You're investing $50,000 from your IRA, traditional IRA, into fund number 2. And you see that 12, 13, 14, 18% return is pretty likely. And you just realize this conversation that we had, that wait a minute, I invested $50,000 traditional, which means the profit that I'm making is also tax deferred. It's now December 17th. I can actually decide right now that the dollar that I invested in January was Roth, which means any of the profit that I made from January to today has actually been growing tax-free. Here are the rules. The first step is I have to decide. And even though it's December and I decided about that dollar amount in January, I have the autonomy to be able to do so. So I've decided that the $50,000 I invested in January is Roth, and therefore all of the 18% that I'm making this year is now Roth profit. But the next step is on December 31st or April 15th, when I file taxes for the prior year, I have to 1099-R myself for the $50,000 that I converted. First step. But notice, I didn't create a special account. I didn't ask permission. I didn't go to Fidelity and see if I could have a Roth IRA. I simply decided. First step is deciding. Second step is I do have to 1099-R myself for the amount that I converted. But that growth, that 18% that I made this year, that's Roth profit. And now the next step is the account has to be in place for 5 years. Again, I'm 51. If we're using me, I'm 51. 5 years, I'll be what, 56? So I still can't use the funds, but that $50,000 that made 18% compounded, based off the schedule that you saw up here, that 112,000 or what, I don't remember what it was, whatever that dollar amount was that my 50,000 made, that's all Roth profit. And then once I turn 59 and a half, I can start taking tax-free distributions forever. All because I decided that these dollars were no longer traditional and they were Roth. There's not one Fidelity commercial you can find that will tell you that, because they want you to think you need them to convert a dollar amount to Roth, and you don't. Does that make sense? Any questions about any of that? Okay. That 5-year rule. The other cool part about that is, as I mentioned, remember I said I invested in January, but I waited till December to actually decide that those dollars are Roth, which means if you wanted to make a Roth conversion, even though there's only a few days left in 2024, if you started today, that you don't have to wait a full year of 2024 in order to accomplish that 5-year moment. My point is, it doesn't matter what day you pick in this year, you get the full year's service of that 1 year needed to accomplish the 5. Does that make sense? And one other piece. As I'm talking today, if you're thinking about creating an IRA or a 401k to be able to have more control over your dollars, you are running out of time. But here's the cool part. As long as you have the account created by the end of the year, and I did say created, you have until April 15th to fund it. Why? Why does that matter? Well, the whole purpose of doing this, if you're using a traditional approach, is to reduce your tax burden. Now, we all talked about being in a Roth environment, but I like to pay less in taxes as well. I'm an entrepreneur. So the common sense approach might be, hey, I need to reduce my tax burden by X dollars. Well, you know what? If you created your account by December 31st, you have until April 15th to fund it. And if you file an extension, you actually have, that says October 15th, but it should be September 15th if you're a business owner. But the bottom line is you have, 9 months to be able to fund your self-directed retirement account for 2024, which is pretty powerful as well. So keep that in mind as we go through this. And remember, earnings are unlimited, which means the limit is your imagination. But the earnings that you can make on your Roth dollars are unlimited. How do we create an IRA? Those of you who have a self-directed IRA, does this structure look familiar? Meaning, we will move those funds into a brand new IRA. The IRA is just an individual retirement account, not that special. It's just a big savings account. The IRA itself has to create an LLC. In order for you to have checkbook control over your retirement dollars, your IRA has to create that LLC. If you don't have this, I doubt you have a true self-directed IRA. 9 times out of 10, you may have a self-directed IRA. You may be able to buy real estate, but you're buying it through a custodian. You're buying it through someone else. Why does that matter? Well, when you involve other people, there's a fee structure that has to be paid. So they're nickel and diming you as you make investments versus you having control. But once the IRA creates an LLC, we take the EIN number of that LLC, create a checking account, and now you have full control over your retirement dollars, penalty-free, in some cases tax-free, to be able to invest in what you want. So that structure is pretty basic. And some people call this an IRA LLC. What they're saying is your IRA owns an LLC, which is what gives you checkbook control over those dollars. It's not a complicated process at all. But notice, IRAs require a custodian. LLCs create LLC fees. So there's a fee structure here. So most people who talk IRAs, they talk IRAs because 9 times out of 10, they are a custodian. And they understand that as a custodian, you are required, you need their support in order to be able to invest, which means now they get to nickel and dime you throughout the life of your IRA because you need them. But there's a way to get around that too. There's some rules associated with having an IRA. Before I jump in, again, I told you I move fast. Any questions about anything I covered? Okay. Key rule. The biggest one is disqualified persons. What do I mean? Well, there are certain people that cannot be involved with your retirement account prior to retirement age. And think about it, it's kind of logical. The purpose of retirement is to assist you when you are no longer willing or wanting to work, and to be able to assist you throughout the rest of your life. If something happens to you, where does that retirement account go? 9 times out of 10, it goes to a beneficiary. In most cases, who are your beneficiaries? It's a straight line of individuals: grandparents, parents, kids, grandkids, and then their spouses, but the most important person is you and your spouse. Pay less attention to who the disqualified persons are, and pay more attention to who I didn't mention. Got a brother? Got a sister? How about a cousin? There's a lot of people that I didn't mention, but the most important person is this guy. Meaning there's an opportunity to be able to invest out. Again, you don't want to have your retirement dollars be impacted by anything associated with your disqualified persons, which means you have an opportunity to invest outside of that. And it's simply stated, your retirement account can't have anything to do with disqualified persons, and disqualified persons cannot have anything to do with your retirement account. Guys ready? You got a daughter who's off to college and she wants, or you want to buy her a condo. Can you? He said yes. Anyone else? No. That's correct. How about your granddaughter asked for a loan? Hey, she's headed to college. She needs some funds. No. Can you? No. Okay. But here comes your niece. And just so we're clear, your niece is not going to college, and she really doesn't need the loan. She just wants to piss off your granddaughter and your daughter. Can you do it though? Can you put her in a condo, have her pay the rent back to your retirement account? Absolutely. But let's keep going. A little tricky. You've got an Airbnb in Mexico, because someone asked, can I buy property outside of the U.S. if I'm not mistaken? So your 401k buys an Airbnb in Mexico, outside of the States. Can you live in it? Maybe. I love that. And so the answer is no, but maybe. You're right. It depends on how long you're living in it. If you're moving to Mexico and you're staying there forever, can you live in your Airbnb? You cannot. Is there a way we can get beyond this? There are some things that we can do, but in most cases, it's a 60-day rule. You can absolutely stay in your own place for 60 days. Let's call it 59. That 60th day, you are causing a problem. But the bottom line is, no, you cannot live in your Airbnb if you purchase it down in Mexico. Last one. This one is a little bit weird, but I actually ran into the situations. That's the reason I put it in here. You have a 401k, and you want to lend from your 401k. So you want to take money from your 401k and lend it to your own personal LLCs to fund whatever it is. This was actually the Section 8 rental. Can you? Anyone else? No? No? It's tricky. So can you borrow from your 401k at the company you work for? Can you borrow from your 401k? So if you have your own 401k, can you borrow from your own 401k? Yes. So if I borrow money from my own 401k, can I take those funds and buy a Section 8 rental all day long? All day long. Key piece to all of these, you don't have to remember any of them. Just know who to talk to. If you have any questions, just reach out. I'd be happy to help.
We should have played the wheel of disqualified persons.
That is true. That is true. That is true. Second rule is there's some things that you cannot invest in. It's really simple. Life insurance, S-corp shares, and collectibles, not to be confused with precious metals. Some people think collectibles like crypto fits in it, and it does not. So life insurance, S-corp shares, and collectibles, but outside of that, it's wide open. And that's where it's really more about your imagination. There are things that I cannot identify. I get questions all the time. I had a guy, he was coming to Phoenix, picking up a U-Haul so that he could drive his gold to the mine. I've heard of people buying gold, but I'm talking, he's buying physical bars of gold, loaded into a U-Haul, driving to the mine. And he had questions about buying property outside of the U.S. using the gold. Why do you want to do but my point is, there are things that you can do with your retirement account that maybe no one has even thought of. The key piece is not these three things. All right. And this is one that most people don't talk about. But what happens if you do? I bought that property on that campus, and I put my daughter in it, and my daughter and her friends are paying my 401k. I didn't know. I made a mistake. What happens if I make this mistake inside of my IRA? Anyone know? Tax penalty is what I would say. So maybe I want to do it because what's a little tax and a little penalty? What happens is you lose your IRA. So let's back this up. You telling me if I make a $10,000 mistake, something minor, like I gave my daughter $10,000 to buy a car so you could drive to school, like, yes, you would invalidate your IRA, meaning you lose not just the dollars in it, meaning now that it's become taxable, but all of the protection that you have with having a retirement account. What this comes from is it was a gentleman going through bankruptcy, and he put everything inside of his IRA because he was happy to go through bankruptcy because he assumed he hadn't done anything wrong. They can't touch it. And bankruptcy court saw that because he went to, not Fidelity, who was it? Not Morgan Stanley. I'm going to make up a name. It was Charles Schwab. I don't know who it was. Let's just call it Charles Schwab. He had opened an account at Charles Schwab, and because he put his name as a guarantor of the retirement account,
Which is required, but based on their paper.
right, Charles Schwab told him this is what you have to do in order to open up this IRA. You have to sign your name. No one reads the small fine print that says you are providing Charles Schwab a guarantee that you will not default on this account. But as a result, that invalidated his IRA. He was only doing what Charles Schwab told him to do. But that alone invalidated everything, and the bankruptcy court took it all. My point is, you don't know. So be careful. The last thing you want to do when you're signing anything, especially as it relates to your retirement account, understand what you're signing because you are what's called a disqualified person. Make sense?
Yes.
All right.
What if you have two IRAs and like they invalidate one IRA? Can you still have the other IRA?
That's a great question. I don't know, but I'll give you, here's what I know about something similar. In order to have a retirement account, there are certain rules that you have to follow. So if you follow the rules in this retirement account and you don't follow the rules in that retirement account, it's a penalty. It can invalidate things. So my assumption is, regardless of how many you have, it could cause the same problem. But don't quote me on that. But my point on this slide is, but I'm gonna show you how to beat it. You can beat these things. You can get beyond these things. But before we do that, let's talk about leverage. Let's talk about, can your retirement account, like I run into a lot of people, especially between that 28 to I'll call it 38 space, and they've worked for several companies, which means they've left a few retirement accounts. And when you pool all of those retirement accounts together, they might have 20 grand, might have 25, might have 32 grand or something like that. And their issue is, I don't have enough to be able to participate in an environment like this because I need 50 grand to do it. Not realizing that your retirement account can actually borrow money, meaning your IRA can walk into a bank and get a loan. Now, obviously IRAs don't have legs, but my point is your IRA can borrow funds. And to understand that, you kind of have to understand what recourse is. Because you can get a loan from your retirement account, but it has to be in the form of a non-recourse loan. But to understand non-recourse, like what does recourse mean? And you guys already know what it means. When you go to a bank, let's say you went to a car dealership to buy a car, but you had to get a car loan. When you got that car loan for that vehicle, that 60-month loan, 72 months, whatever it is, when you sign your name, what does your signature mean? Your signature means, if I default on this loan, they can come after who? Me. They get to sue me if I don't follow through with this agreement. So which means the bank's recourse is to come after me if I default. So I'm giving my personal guarantee. Okay, but this is an IRA. What's the number one rule for an IRA? Disqualified persons. Who's the number one disqualified person? Me. So if I wanted a loan from a bank, can a bank require me to provide my personal guarantee? They can't. So how do they lend? They lend to your IRA, they lend to your retirement account based off non-recourse. What does that mean? They're lending to you based off the opportunity. Let's say I wanted to buy this Christmas tree with my IRA. The bank's going to say, what is the Christmas tree worth? Is it worth this loan? We're going to lend based off the opportunity or the probability that this Christmas tree will increase in value over time. So they will lend from a non-recourse perspective based off the value of the thing that I'm buying, not me. And here's why this is important. It doesn't matter what your credit score is. It doesn't matter if you have been through a bankruptcy. It doesn't matter if your credit profile is sufficient or not, because they're lending based off the opportunity, not based off you. So what that means is it doesn't matter if you have $5,000 or $3 in your IRA. Your IRA can absolutely gain leverage from a lending institution or a non-recourse lending institution because it's based off the side, what the value of the opportunity would be. Does that make sense? So I say this to say, it doesn't matter what you have. What matters is the opportunity. I've got a lot of young people who do a lot of wholesaling. And again, they might have $3,000 in their retirement account, nothing much. But through wholesaling and non-recourse lending, they can actually accomplish very similar to what you've done, and that's put themselves in a position where maybe they can buy a property that they live in one side and pay the other, or have a tenant pay the other. Did I cover that? Yep. So the lender is taking the property based off collateral, which means there's no personal recourse, hence a non-recourse loan. All right. So we've covered a lot, but we really haven't. Yes, sir.
Would the asset be recourse for them?
Say that one more time.
Would the asset be recourse for them, like the asset back?
That's a great point. So if you default on the loan, what happens? They will take the property, but they cannot come after you. That's the key piece. They cannot come after you. They will come after the property, but that's okay, right? All right, so IRAs are low-hanging fruit. And they're low-hanging fruit because they're easy to create and you need a custodian, and custodians will nickel and dime you, meaning they get to make funds off of you for the duration. There are 3 types of custodians. So pay attention to the type that you have. The first type is Bank of America, Edward Jones, Morgan Stanley. You can invest in anything that these custodians have to offer. But if you wanted to buy property from Bank of America, you can't because they don't allow you to. Yes? Then there's the custodians that you can invest in what you want, but they're going to charge you for it. And those are your equity trust, your IRA services. Those are those custodians where you might have a self-directed retirement account, but you can only invest what the custodian allows you to invest in, or you have to invest through that custodian. And then there are the passive type, meaning they are FDIC insured just like every bank, but they're not standing over your shoulder, making sure they're not standing over your shoulder telling you what you can or cannot invest in. This is what you want. You want a passive custodian that will allow you to invest where you want and how you want. And there are thousands of passive custodians out there. Just so we're clear, any of these banks can be a passive custodian if they choose to. And I go back to choose to. Most custodians fail to ask some simple questions. The first one is, do you have any self-employed income? If you're in this space and your objective is to become a real estate investor, this should be a no-brainer. So let me ask in the room, do any of you have any self-employed income? Yes or no? Yes? And the other is, do you have any full-time employees? And if the answer to this question is no, we shift. But just so we're clear, oh yeah, that was right. Yep, so we shift to self-directed 401ks and we do about 20 times more self-directed 401ks than we should. I'm doing something special for this group, so a quick commercial. If you are wanting to have more conversation around your specific situation, I doubt we'll have enough time to cover most of it today, but I am opening up my calendar tomorrow for little 15-minute slots just to identify where the opportunities might be. Maybe you have a retirement account already. Maybe you have a self-directed IRA or self-directed 401k already, and you just want to make sure that your retirement dollars are being leveraged the way they should. Please feel free to jump on my calendar. This is a quick QR code if you want to be able to book some time with me. I'll be here all day tomorrow and part of the day Thursday, if I got my days right. So please feel free. Up, did you get, I'm sorry. Did you get it?
Got it.
Got it. Perfect. Again, we do 20 times more 401ks and IRAs just by asking those two questions. And this is the one that I get often. But what if I don't have any self-employment income? There are many ways to go about it. You can sell stuff on eBay. You can do 1099 anything. You can do Uber or Uber Eats or whatever the case may be. But here's the key piece for me. I am done having conversations about whether or not you should or shouldn't have self-employment income. And here's my point. If we can't agree on anything else in this room about this incoming administration, I think we can all agree that this next administration is very business friendly. Can we agree on that? Yeah. So you should not be leaving this space without some type of self-employment income, because the benefit to you having it is probably exponential at this point. So are you doomed to an IRA if you don't have self-employment income? You're not. But the truth is, none of us should go into next year without some form of self-employment income. And I don't care what it is. Get you an Amazon store. I really don't care what it is, because you want to be able to take advantage of all the tax benefits coming with having your own business. Does that make sense? And I share this not just for you. I go back to when you go back into your neighborhood, pay attention to the people around you who are going and doing their 40 to 80 hours a week every week thinking they have enough. They don't. And also, what if you already have an IRA or a 401k at your job? You can have as many 401ks as you want. What's required to have a 401k is just simply a business. You just simply need self-employment income to be able to have it, and no full-time employees. And when I talk about a self-directed 401k, I'm talking about zero custodial fees, zero custodial interference, and no investments lost due to waiting on being able to take action. So it's about control. Now, to have a 401k, it does require a sponsor. And that sponsor can be any LLC, any S Corp, any C Corp that already exists. Similar to the IRA, you have to create an LLC. The IRA has to create and own that LLC. This is different. Any LLC, any S Corp, any C Corp, any 1099 income is enough for you to have your own 401k. So without a custodian, how does it work? You are what's called the trustee. Most people don't realize this, but your current company's retirement account, your current company's 401k is actually a trust. It's just they've removed some of the backing or the structure associated with it that gives you all of the capabilities that this self-directed 401k has. Meaning, you all have a trust. And if you know anything about trusts have their own EIN number. Which means when it comes to creating a self-directed 401k, what does that look like? We would move those funds into the new self-directed 401k. Because 401ks have their own EIN number, there's no additional structure required. So you take the EIN number of your trust, and now you have checkbook control over your retirement dollars. Oh, sorry. So the process for creating a 401k is a lot simpler, a lot more clean. And in addition, the ability to commingle funds between your retirement account is there, meaning you and your spouse can both commingle retirement dollars in your own self-directed 401k. What does that do for you? Well, now when we're talking about dollars to be able to invest, it gives you a much larger pool to be able to invest from. And again, how many you have, all of them can go into one 401k. The cool part about that is if I'm eliminating an IRA that I have and an IRA that my spouse has, IRAs require custodians, custodial fees, maintenance fees. I just not only consolidated retirement accounts, but I'd reduced the number of fees being paid to banks by simply commingling funds between myself and my spouse. Oh, and my other favorite slide is this one, contribution limits. We talked about the IRA contribution limits being $7,000, up whatever that dollar amount is since 1974, whereas here, contribution limits for a 401k in 2025 would be, $69,500 if you're under the age of 50, and $77,000 if you're over the age of 50, which is pretty powerful. Way more than the $7,000, $8,000 that you're able to contribute into an IRA. And the other piece is that, which I kind of touched on earlier, is you're able to borrow against your 401k and use those funds for whatever you want. So that can I leverage funds from my 401k to buy a Section 8 property? Absolutely you can. You can borrow for 50% of what's in it, up to $50,000. And if you have a spouse, that's times 2. So that's $100,000 that you can put in your pocket. Now with a loan, and I did say loan, you'd have to pay it back, but you set the terms. You set the time frame. The rules look like this. You can borrow that 50% up to $50,000. You can use the funds for whatever you want. There is a payback period, but you set the terms for what that looks like, whether it's quarterly, monthly, however, and the interest rate. It's just as simple as filling out a promissory note and assigning it to yourself. And then the piece that isn't in here is if you use these funds to purchase a primary residence, a residence that you're going to live in, instead of 5 years, you actually have a 15-year payback period. It's pretty powerful. And again, same thing. You get it done before December 31st, you actually have until April 15th to be able to fund it. So we've covered a lot. IRAs require custodian, 401ks does not. It's a trust. IRA, lower contributions, 401ks much higher. IRA, if you wanted to leverage or borrow against an IRA, the only way to do it is with a taxable or penalizable distribution, whereas with the 401k, you can borrow for 50% of what's in it. IRAs, individual retirement account. You can have one, your spouse can have one, which means you have custodial fees, your spouse has custodial fees. Where's the 401k? One plan for both. IRAs, very simple. UBIT applies, 401ks, UBIT does not. UBIT stands for unrelated business income tax. You do not want to get hit with UBIT. That's a 35, 37% tax on your profits. IRAs require structure, requires an LLC in order for you to have checkbook control. A 401k is a trust. It has its own EIN number for checkbook control. And then limitations on income. I don't talk about this anymore, but IRAs, if you make too much money, you can't contribute your $7,000, which is ridiculous. With the 401k though, there are no income limitations on being able to have one. And prohibited transactions. In most cases, a prohibited transaction in a 401k is a penalty, whereas in an IRA, you lose it, which is pretty powerful. Which would you prefer? So we've covered a lot. Any questions? Because I am done.
At any point, whether it's an IRA or 401k, you put it into, Adam's fund, you get your 18% annually, let's just say.
Yep.
That has to stay into that vehicle until you're 59 and a half years old. If you take any of that out, you have to pay taxes on that. Do you also get hit with the 10% penalty just as emergencies?
Yep. So a couple things, because there's a lot there. You invest, the return has to stay in that 401k. You're absolutely correct. Once you hit 59 and a half, any distribution you take, if it's a traditional retirement account, you're going to pay taxes on it, but you will not be penalized. Again, I like to focus on a Roth environment. So I would suggest if you're not close to 50, how do you transition those traditional dollars over to Roth? But the moral of the story is there's no penalty as long as the dollars stay in the account, stay in the 401k until you hit 59 and a half. But if you needed some of those funds ahead of time, you can always borrow against. Yeah. And again, you set the terms on that. Great question. Yes.
I recently learned that if you have a 401k, if you use a Roth 401k and a Roth IRA, you can take your transfer money from your 401k to your Roth IRA, whatever. But then when you have any of the money that you invest yourself into your 401k and then transfer it to a Roth IRA, you can take all that money out, all of it, and not the interest, and not pay taxes or penalties.
So I'm going to restate. I think I understand what you're saying, but let me restate it. Because what you're talking about is a backdoor. They call it a backdoor Roth IRA is what they call it. And the truth is, it's just a backdoor ATM. And here's all you're saying. However you do it, if you have a Roth account, whether that's a Roth IRA or a Roth 401k, they both work the same. The money you contributed into the Roth IRA or the Roth 401k, you've already paid taxes on. Right. So if you needed access to the basis, let's use hard numbers. You contributed $50,000 into your Roth IRA, but there's $500,000 in it. That $50,000 you contributed, you can pull out at any time because you've already paid taxes on it and there's no penalty to do so. So it's ultimately a backdoor ATM for you. If you need access to your bases, you always have it. So
Should you, basically, I'm learning a lot from you, so like, we shouldn't do that, I guess, is what I'm saying, right? Like, you shouldn't take that money out and go invest it, you should keep it into this ecosystem and then invest it that way. That's probably the best way to handle it.
I hope we get a chance to build a relationship because the truth is, I'm about leverage.
Right.
I'm not going to say you shouldn't. My question will probably start with why. Because there may be a situation where this makes sense. Because maybe you need the liquidity to be able to take action that you don't want to take action inside of your retirement account because you can't access those funds till you're 59. But maybe I want to borrow $50,000 and go put it in this vehicle over here so that I can access those funds today and make money off those funds today, and I'll pay myself back. But it may logically make sense. So would it make sense to do take a backdoor option, take my bases out and go do something externally? It may.
Yeah, I
But-
guess it comes from like, I'm kind of learning from you, 'cause, like,
Yeah, yeah.
the big thing is like, nobody can tell you what to do with it, it's your money. You can
That's
spend
the
it, and
part.
I think that's kind of what you're teaching us.
It's about control. It's about you having the capability to be able to take action, and you're not waiting for someone to decide, or you're not waiting to ask permission. It's you have the autonomy and flexibility to be able to do what you want when you want. And to me, and that's where this is not an or. Please, if it comes off as an or discussion, I need to do this better, because this is not an or discussion. This is in addition to what you're currently doing. If you just stop there, it's not enough for you to be able to accomplish your goals. So what are those additional things? Where is there an opportunity in this space for you to be able to do some and action? Does that make sense? Great question, though. Yes, sir.
I think you talked a little bit about
Electing to be
like Roth money by the end of the year or something.
Yeah, yeah.
Is there a limit to how much money you can convert from like the IRA to the Roth?
So I would say it's all about your tolerance as to how much you would want to pay in taxes,
So
because it's really up to you.
yeah, strategize my
CPO.
so ideally you're gonna pay 0% taxable income and then convert all that money for free.
Exactly.
Okay.
Exactly.
There's no limit on that money.
There isn't. There isn't. And that's that Rothicized piece. Because again, for me, if I've got X amount of years before I can touch it anyway, I may as well stretch that out. Or if I'm having a year where, you know what, I can take more of that tax burden on now. Yeah, you're absolutely correct. Any other questions? Well, if no other questions, I thank you guys. And I'll be here. So if you have any other questions, we can also talk as well, but I appreciate it. Anything?
No, thank you so much.
Okay.
Yeah, please book time with him if you guys are interested at all. Thanks for everybody. Stick around, hang out for a little bit. Appreciate everybody coming out. Thank you.